Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Robert Alex Baker and Kent Liggitt from Coastal Equity Group. This is a private lending shop based in Charleston, South Carolina that focuses on residential rehab and ground-up construction loans. We talked about their lending activity, trends that they're seeing, loan programs with specific guidelines, a little bit about their company history, their capital structure, and I also asked them to share some insights about some of the markets that they lend in. I hope you find this episode to be insightful. Here's my interview with Coastal Equity Group. All right, gentlemen, thank you for joining me for this episode of Private Lending Insights. It's been great to watch Coastal Equity Group grow over the last 2 years or 3 years. Alex, we've met close to when you were first starting up in private lending, and it's been nice to see the enormous loan volume you guys are doing. So tell us a little bit about your lending activity the last year or so, and then we'll get into a lot more details.
Absolutely. So I started the fund in 2018, and it was definitely a very interesting year. In the beginning, it was right when a lot of that institutionalized capital was coming into the marketplace. So before that, we were really balance sheeting, and then we were able to bring on some good partners, and we were able to sell some of our paper on the secondary market, especially in 2022, 23 is really when it got to an exponential growth. And then in 23 and 24 is when we really started to grow our team. We broke everything into departments, which has been great. Before that, we were wearing multiple hats, all of us, and now we actually have a servicing department, a sales department, a marketing, and so forth, and underwriting. So it's been great to see that growth. And last year, we closed a little bit over 200 million in terms of loan volume. So we've seen exponential growth year over year. Have really the Southeast. So we're based in Charleston, South Carolina. Love that area, especially North Carolina, South Carolina. Do a lot in Florida, and just have seen really good growth with knowing our products and being able to stay in the areas that we feel comfortable lending in.
Nice. And speaking of products, could you tell us about the types of loans that you're doing? Are we talking mostly about fix and flip, or are we doing more ground-up construction these days?
So we do both. We actually are seeing a lot more in terms of volume of ground up construction. I would say about in terms of our pipeline and our annual basis of 25, we saw probably around 70% ground up construction. We've actually seen a lot of our flippers that were with us from earlier years start to graduate into that ground up construction product for a plethora of different reasons. Obviously easier to sometimes manage your costs and expectations moving into that, along with just what's available, what's going to make sense, and so forth. So just depends on a few different things there.
Did you say 70% of your loans these days are ground-up construction?
About 70%. I know, Kent, you can touch more on that too, what you see.
Yeah, for sure. Definitely have more construction heavy too. And I think it's kind of like the geographic areas that we're lending into. I mean, it really depends because like here in Charleston, closer to downtown area, I mean, there's a lot of like old established neighborhoods. And then same thing, like the further you go out from the peninsula, there's just like the neighborhoods are kind of unique. I mean, people are buying $1.1 million ranch style houses, building $5 million monstrosities, these huge, huge properties. And we've just seen a lot of that recently, and also in some areas of Florida as well. So the teardowns have been big, just kind of buying those 1970s houses that were built and not really upkept. And as opposed to rehabbing them, they're definitely taking advantage of the location and building some bigger houses on those lots, which is what we've seen. But yeah, this fix and flip volume has been steady. I mean, we do deal with a lot of flippers that are, I mean, their bread and butter is that middle price point range. So, I mean, we've seen that as well, but the construction's definitely been our heaviest program for the last 18 months at least.
Nice. And with the construction projects that you fund, are a lot of them just one house, or are there a lot of, multi-house developments?
So we are kind of stay in the lane of 1 to 4 unit residential for the construction. The multi stuff we don't really mess with. It's mainly been that $1 to up to $3 million price point. We've seen that some good success with that. Our borrowers are, and that's not like the top end of the market, but it's been a pretty liquid asset from what we've seen.
And so you're not doing as many of these projects where the developer's putting in about 5 or 10 homes. You're saying that it's mostly single properties, right?
From the most part, yes. We do a couple of small development stuffs, but we really are, that's not really our lane. We'll do some small subdivisions, like say up to 15 lots, that sort of thing. We haven't seen any issues with those as well. We've got a couple guys here in South Carolina doing that, like this sub 10 lot subdivision, and they've had some good success with those as well. But the most like inquiries we get, a lot of our guys are coming to us say, hey, I want to do a $3 million build here. So it's been a lot of that.
Nice. And if you could just tell me about some of the trends you're seeing, like are most of your borrowers exiting into a rental versus a sale? Tell us about any of the other trends you've seen in the last 6 months or so that may be different from past years.
For sure. I think the majority of our people are definitely building to sell. But one of the interesting trends that we've seen is a lot of like builders that are doing for fee work. They're like ready to go out on their own and do specs. I mean, I think they're getting tired of dealing with the like the clientele for the high end. Like they basically have nitpicky clients and all that sort of thing. They've kind of wanted to switch over into the spec world, and we've seen some of that with our guys here in Charleston. In some of the more high end areas, they've been doing the high end for fee builds, but they're kind of, I guess, a little fed up with dealing with that and want to have more control over the projects themselves, which is what we've seen a lot of that recently, especially locally, which we love to see.
So these are general contractors who've been hired to build for other people, and then they're getting into developing their own projects using Coastal Equity Group, right?
Right. So we can actually count so if you come to me, so I'm a home builder. I've done 10 custom homes for clients over the last 3 years. Then we can just go in and see if you have the certificates of occupancy that you've done those builds, and then boom, you're off to the races. So that's how we qualify you, like with your for fee experience. So you don't necessarily have to have done a spec yourself to come get a loan with us. So that's been a big selling point. It's been a good product that we can offer to our builders.
Yeah, I love it. So whatever experience requirements you have, which almost all lenders have for ground-up construction projects, even if they haven't been the investor or borrower on a particular project, you'll just look at their experience as a general contractor, and use that, and they get kind of the same structure as far as leverage and pricing as an investor that has done a lot of builds on their own as the investor. Is that right?
Yeah, exactly. I mean, we're obviously looking if they've only done like 10, $200,000 builds and they want to come to us for a $3 million build. I mean, that's going to probably we'll have some issues with that. But yeah, we're verifying their track record of like-con projects. And then obviously making sure they have the liquidity reserves on hand to help them do the project safely and without having any issues or shortfalls. So yeah, we've seen a lot of success with that. We're really into the ground up space. Like we love those projects. I think it's kind of our bread and butter here. So yeah, I mean, with us being able to offer that to the GCs and builders that not necessarily have done deals themselves yet, but want to get into it, it's been a huge advantage for us.
For housing sales, especially in the Southeast, for all the areas that you lend in, have you seen any challenges with properties getting sold or projects having to extend because they can't sell? Tell us a little bit more about that.
So that's a great question. I think, and it kind of ties back into the price points that we were talking about earlier. I mean, we've seen the price points from, I would say, like what, Alex, $1 million to $2 million. Those have been pretty very liquid, but some of the immediate like 500K or below, that's kind of been the stuff that we've seen sitting. I think it just has to do with there's a lot more cash buyers, a lot more wealthy people in the markets that we're dealing in. So they're going for that little bit slightly higher price point. But yeah, I think that the lower values have definitely been the ones that we've seen just sit a little bit longer. Obviously there's more inventory out there at that price point. And I think you have about a lot more cash buyers in the market, wealthy people moving into the Southeast. I mean, especially with us, there's a lot of domestic migration occurring, especially South Carolina, North Carolina, Georgia. People are moving down from New York, and they've got their New York salaries and just can buy a house cash here in town. But so that's what we've kind of seen on our end. Alex, I don't know if you want to add on to that.
Yeah, I mean, I I think one thing that we definitely have seen that there was, definitely a lull in the median home price range for a little bit, especially in Florida. We saw definitely on the west coast of Florida. So basically that Tampa all the way down to Naples area has there was a lot of oversupply there. We actually kind of took a little bit of a pause in terms of funding for a little bit there till we, could understand prices and valuations to the best of our ability. But we did see a little bit of oversupply there. We're starting to see that correct too. I know there were some issues, at least with one of the biggest concerns with us is insurance, right? So anything coastal, you're going to have very high insurance. So a lot of times back in the day when people used to have the exit as a DSCR in terms of a rental, the numbers would shake out. But now that rates are higher, and then we're seeing these insurance premiums go a lot higher as well. That's been harder to have as an exit. So it wasn't, necessarily let's say pre-COVID, that was kind of your fallback. Now it doesn't always work out that way. So we have to really look at the valuations in terms of ARVs, just with a second set of eyes, to make sure that that you weren't appreciating markets and that we're not seeing an oversupply.
And the insurance issue, isn't that a problem in other states and other markets besides West Florida?
Oh, absolutely. Yeah, anything coastal, which obviously we do a ton. And so yeah, so South Carolina, North Carolina, premiums are much higher. We saw much more of a spike in Florida as a lot of carriers pulled out, especially with the recent hurricanes. Thank goodness, no major hurricanes this year down there, but there were, a lot of hesitancies in terms of if we were even able to get insurance bound. So that there were a lot of questions there for the meantime, and the coastal properties, that's always a factor to be considered.
And so going back to what Kent said about the lower valued properties maybe sitting on the market longer because there's a lot more inventory, are you pushing to get more loans funded that are in the higher price range of let's say $1 million to $2 million?
I mean, yes, we're always. I mean, if it's a bigger deal, I mean, we'll like we like to say. I mean, it takes the same time to do a large deal and a small deal, and also, I mean, we look at those smaller deals like a little bit more with a little more scrutiny, just because of that fact that we see them sit a bit longer. So if you come in with us with a $400,000 ground up loan that you want to do, you might not get as high leverage if you want to, depending on the market at that price point. It's just we're going to take a little bit more of a deep dive into the comps and just make sure we're really like going off a realistic ARV value, not just what the appraisal says, just what we've seen that's actually selling in the market. But yes, I mean, in short, I think we are pushing for some higher loan amount deals. I think our average loan amount for 2025 is around $1 million, so it's pretty in line. But I mean, we'll do loans down to 200,000 if we like them. So
Nice. And let's talk about capital markets. How's capital doing for you guys? Are you seeing any changes in capital markets in the past 6 months?
So rates, I see are coming down. The leverage box is opening up, but also within that, it's getting more strict. So the box itself has gotten bigger, but in order to get approval of to say the max leverage within that box, you're going to go through a little bit more scrutiny. And it's the 9 times out of 10, the value is going to be the main kicker on that. So if you have a value that's really well supported, then you can definitely the deal underwriting will be smooth sailing. But if there's some kind of questions around the value or the price per square foot, or it's just not really well defined in that area, it's just that can be problematic. And we're usually going to do a little bit of a leverage chop there just to keep everybody safe and make sure the borrower's got some ample protection there. One thing that we've seen, for instance, that I've been running into is some of the submarkets in South Carolina, and specifically, they have a lot of homes that have been built for clients that have owned the land, and there's no sales price, but you're the builder's building them and they're using these hey, this property is going to be worth this. And I know for a fact that they bought it from the builder for this amount, but it's not shown on an MLS. So it's just there's problems like that we've seen in some of the areas with the new builds and the comps that we're tying out. But for the most part, it's been, we've really been enjoying the ground up product this year.
Amazing. And so we're recording in February 2026. For the rest of this year, do you have any expectations, predictions as far? I mean, what are there any concerns that you have looking, towards the next 10 months as far as lending and capital markets?
I'm optimistic for this year. I think everybody, the kind of the jitters of what we had seen going into 2026 are going. Yeah, it's just kind of gone away. But I mean, I'm optimistic for the year. I mean, like I said, the box is getting bigger, but the guidelines are getting stricter. I think it's just we're going to have to be a little more thorough with the underwriting, and that also goes into our borrowers. Like, hey, let's really take a deep dive in how you're seeing this value or how you're getting to this sales price for your new build. So it's just a conversation now with the borrower, setting realistic expectations. It's just making sure everybody's going conservatively on their numbers on the underwrite.
And from what
And
oh, sorry, go ahead.
oh no, I was just yeah, to piggy off Ken, I completely agree with him. I think we're definitely seeing a ton of liquidity still in the marketplace in terms of cap markets. So you're seeing those boxes open up, but I would say key is valuation. I think there's still people that are in the business that are trying to push unrealistic valuations in terms of ARV. So it's really sometimes we've had to put a lot of scrutiny in terms of those numbers, and just being a little more cautious and not pessimistic per se, but just being proactive if you're not going to see that appreciation that we've seen previously.
Yep. And on top of that, also kind of going back into the experience portion, I think the valuation and then experience of similar projects, I think we're really going to be looking at more like, okay, the range of the builds that you've done in the past. I mean, like I said, as an example, the 200,000 to $1 million budget jump from your last project to your current project you're trying to get financed with us, that might raise some questions with us, and we might want some extra liquidity reserves or something else to help compensate that factor. But yeah, it's just looking kind of a little bit more in depth into actually the borrower's track record and obviously the valuation.
All right. And based on what you've seen so far with how the year started out, what are your expectations for your business as far as growth? Do you expect to do a similar amount of loans that you did last year? Do you expect a high amount of growth, a slowdown? What are your thoughts on that?
Yeah, I mean, we're in the hopes of probably doing, I want to say about, let's see, probably 30 to 40% more than last year. I think that takes into realization though too that we're growing our team, especially our sales team. So for us, we really wanted to build really good systems and processes in place in HQ. And now it's our first year of actually hiring remote biz dev people in different markets. So I think for us, we're really excited about that possibility of growth where there's actually boots in the ground of other metros that we want to expand into, and also to help cultivate and build new relationships in those submarkets and those metros and submarkets around there too. So that's kind of where we're seeing our growth just from a company perspective, hence kind of our numbers.
Are you mainly seeing builders that have worked with banks and then they move over to private lending? Where are most of your builder clients coming from these days?
And honestly, I wouldn't wrap them all into one bucket, because you've got some guys that have been using their banks for their one-off deals like once a year, and they want to scale up, and they come to us and say, hey, my banker buddy won't give me two at a time. Can you do this one? And we're like, absolutely. So, I mean, that's been a situation where we've been able to help. And then usually once they do that first one, they're like, wow, this is super easy. I'm not coming back to the bank again. But it's that. And then coming from other private lenders and hard money lenders as well. I think it's just getting really competitive out there. And I think the main thing is really your relationship with your lender. And a lot of these guys have been dealing with some people that they may or may not have had like a really personal relationship with. And that's what we try to do, is been a more personal approach, and they can reach us whenever. The process, we do a lot of hand holding and stuff behind the scenes to make it easier for them, which I think they like a lot. Because it gives them more time to focus on actually building the house as opposed to dealing with somebody in the office requesting documents, that sort of thing. But yeah, I think everyone's out there just kind of looking around, seeing what the best option is and who's the easiest to work with. So I always try to put our best foot forward in that front.
Yeah, and speaking of competitiveness, I mean, the Southeast seems to be the most competitive market, especially with construction lending. And, we also have a huge demand from lenders wanting to be on our platform in certain states. And from the data I have from, I have access to Forecasa and Elementix. Both are great data platforms. I could see the number of loans that you've funded, and it seems like the top states are South Carolina. After that is Florida, then I believe Georgia, North Carolina, and Tennessee. Um, so those are your primary states. Do I have that correct, first of all?
Yeah, that's correct.
And do you have plans to expand in a big way into other states beyond the Southeast this year, I should say?
Not at this time. I mean, if there's a repeat borrower of ours, I mean, there's a couple states we can do. I mean, like Hawaii, for instance. Alex grew up there, and where legislation allows us to lend there. So we've got a couple repeat guys out in Hawaii. If it's a one-off state and we like the deal and we're familiar with the borrower, then we'll take a look at it if we're able to lend there. But we don't really have any plans to expand outside the Southeast. Like not at this time. I mean, the market share in this area is just huge. And like you said, I mean, it's a very competitive market too. And I still think there's a lot of business to be had. And we're kind of focusing on our strengths, and we're really strong in South Carolina and Florida and those other states that you mentioned.
Yeah, and I think Kent, the one thing that Ken had brought up was, really about the customer experience and customer service that we provide. We definitely want to be a quality over quantity shop. So we love, doing a plethora of different projects with one borrower versus then, 20 different borrowers with one project. And that kind of goes with our states too. So if we can focus and, have really good market share and understand our markets really well, then we're able to, be a better lender too, to understand what's going on in the state, understand trends, understand what borrowers are seeing and what's going on.
Yeah, it's also easier to underwrite our like local deals in the markets that we know well. Because Alex started off flipping in the Southwest Florida area, the Tampa area. I was really familiar with that market. I'm born and raised South Carolina, just like the majority of our company is. So it's a lot easier to underwrite a deal when you get the address. I know exactly where this is, as opposed to where is this. I mean, I have to start from square one.
Yeah, love it. All right, we'll come back to getting into some of the states and the different markets, but before we move on, I wanted to also ask about DSCR loans, or is that something that you're doing in a big way, or is it more of a kind of a smaller sector of your lending activity?
More, I mean, we'll entertain DSCR loans, but the majority of the ones that we do are for exiting our current loans, like for repeat clients. So if they come to us, do a build to rent, we'll obviously do the DSCR loan, or same thing with flips as well. But that product is even more competitive, I feel like, than the ground up and bridge loan stuff. So, I mean, we just got back from the Builders Expo in Orlando, and the amount of people asking about DSCR loans, you wouldn't believe it. And I really think at that, like for those loans, you have to shop the rate if you're really wanting to maximize your cash flow. And I mean, even if it comes down to like an eighth of a point, they're still, most borrowers will still take that option over your customer service aspect. Because once you close the DSCR loan, it's not like you're dealing with draws or anything like that. So you're really just set it and forget it. So I've seen the competitiveness in that just been kind of a deterrent, because you have a lot of people that are shopping. They'll get you to give them a term sheet, and then you'll never hear from them again. So we really are just kind of refining our own loans if our clients want us to. But yeah, we do offer that option.
All right. Well, let's forget about DSCR then and focus on ground up and rehab loans. Let's go over some of the guidelines. Tell us about your minimum and maximum loan amounts at this time.
So minimum loan amount is 250,000, and then maximum loan amount is 5 million. So we can actually do $5 million single family ground up project. We can't go over. So per parcel, we're capped at 4 units. So the biggest building we can build is a quadplex on a single parcel. We could do 4 combined quadplexes. So there's 16 units, but usually just in the 1 to 4 unit space. But yeah, once you start getting up into the higher loan amounts, I mean, obviously the underwrite's a little bit different. We'll require 2 appraisals for any loans over 3 million. But other than that, it's pretty straightforward. That's when we'll take a deep dive into seeing, hey, have you done any of this projects of this size? And just do a little bit more due diligence on that front, making sure that we're not building the nicest property in that neighborhood. That's always an issue. But yeah.
All right. And then with rehab, fix and flip, or rehab to rent loans, what what's the leverage that you're offering at this time for those?
So for middle tier, we can go up to 90% loan to cost for light renovations, 85% loan to cost for heavy. And then if for top tier, which would mean you completed 10 in the last 3 years, we can actually go up to 95% loan to cost on light renovation flips, which that rolled out recently and we're pretty excited about. So it usually works out to 90% towards purchase price, 100% of the rehab finance. So that's been good. We obviously we're going to be capped at 75% LTV or LTARV for the light renos across the board. And then if you're in the middle tier for heavy renos, you're capped at 70 loan to ARV. So,
Okay, great. And what's the average interest rate for rehab loans at this time, a minimum and a maximum?
for rehab loans, so we've really simplified our pricing process. So flips across the board right now, I believe, are 9.25, and then the ground up, I believe, is 9.75, just across the board. I mean, the more deals you do with us, we're going to obviously make those terms a little bit more favorable to you. So for instance, after every 4 deals you do with us, your origination points drop by 25 basis points down to a 4 of 1. So that's always appetizing. You'll start out at 1.75 usually with us. But yeah.
Wow, that's quite attractive. So most of the loans you're funding these days are under 10% interest.
Oh yeah. Yep. They changed over the last like 6 months or so. I mean, I would say, yeah, maybe a little bit longer than 6 months ago. I mean, we've been in the 9s probably for since like June or July, I would say.
Yeah. And we really just wanted to make it as simple as possible, as Ken had said too, just so, I mean, it helps us as a team as well, just to know, exactly the product we're selling and kind of what expectations are from the client perspective as well. And I think it just makes it just, much more simplified in that sense to have a couple different loan programs and have your one rate per program and set expectations that way.
Great. And Kent, just to clarify, you said there was the origination fee was 1.75. Was that correct?
Starting.
Okay.
Yeah.
Okay. So 1 3/4.
If you have no experience, it'll be starting at 2. That's for 0 projects completed, but middle tier and up start at 1.75.
Okay. Sounds good. And let's talk about leverage for ground up construction loans. Are you participating in land acquisition, or are you giving builders credit for land they've already acquired?
Yep. So, I mean, if their land, if they own it outright and it covers their equity portion, then they're basically like that. We'll obviously take that into account, and they'll be not coming to the table with any funds, and they'll essentially just receive the construction budget. We can do land acquisition, but it has to include the vertical. We can't just do a land loan bridge acquisition, but we can go up to 60% towards the purchase price of the land, and up to 85% total project cost for that middle tier. Above the middle tier, we can go up to 90% loan to cost and up to 70% LTV towards the land value. The requirement for this 70 LTV would be your permits in hand at the time of closing. So pretty competitive, but that 70 LTV number.
But what if they don't have permits in hand and they're expecting to get it within a few months?
That would be capped at 60 LTV.
Okay, so you would fund 60% of the land acquisition combined with the construction funds, but obviously they're not getting construction funds until they've acquired their permits.
Correct. So it'd be say the land was 100,000, we're giving them 60 at the closing date. So that's the interest bearing balance. So they wouldn't be taking any draws until they had done any work. So we're funding 85% of the total project cost. So say we have 100% of the budget finance, we'd close the loan. They've only been paying interest on the 60 for that 3 months. Then once they're ready to take their first draw is when that interest bearing balance will kick in after they receive draw 1. But yeah.
All right, sounds good. And then as far as the experience, we talked about it a little bit earlier for ground up construction projects that they need to have some experience, and it could be as a general contractor, not necessarily an investor developer. But is there a particular number of projects that you require them to have completed? Is that 1? Is it 3?
Sure. Yeah. So if they're on title, then we would need to see 3 three completed, and if they were taking into account their build experience. And so this, let me just clarify. So if somebody worked for a builder and they weren't on the permits, then we wouldn't be able to count that. Like you would have to be your GC company. I did this for the clients, and my names are on these certificates of occupancy. In that instance, we would just need five to qualify you. Uh, but yeah, I mean, we're obviously looking at the on title projects. If you have 10 on title projects, you're fully good to go. And then if you've got 10 new builds that you've done for clients, you're also good to go at that top tier. But minimum would just be 3 on title or 5 for clients.
Okay. And what about experience requirements if it's a rehab?
Yep. So the rehab loans, we can do no experience, but it's going to be at 80% loan to cost, and your minimum down payment's 25% of the purchase price. So it is lower leveraged. We're going to be capped at 70 LTARV on that. That's up until you do 3 deals, then you'll move into that middle tier with us. But mid-tier experience, which is between 3 and 9 projects completed, that's going to be capped at 85% loan to cost for heavy rehabs and 90% for lights. And then once we get into that top tier, you're up at 95% loan to cost for your light renos, and then 90 for heavies.
Great. And what about credit score? Is there a minimum credit score, and is it different for rehab versus ground up?
Correct. So the minimum FICO is 680, and for ground up construction, it's 700.
Okay, easy enough. And let's talk about liquidity. What are the liquidity requirements let's talk about rehab first, and then we'll do ground up construction.
For sure. Obviously, we're going to want to see cash to close for the flip loan, for the rehab loan. So we'll have to see that amount plus 6 months payment reserves, and then 10% of the budget amount. And keep in mind, Rob, we just need to see this in an account that the borrower has access to. We can also include like 401ks or investment accounts. Those will be subject to a 60% haircut. Obviously, we'll count 60% of the values of those. But yeah, pretty simple because you can use a combination of accounts as long as like from multiple guarantors on the loan, just as long as they have access to those funds.
And is it any different for ground up construction?
No, that the same requirement there. It does usually work out to be a little bit heavier of a dollar amount than obviously the flip loans, but yeah, 10% budget, 6-month payments, and then cash to close. But if it's a situation where the client owns the land outright and they're receiving cash out at the closing, we'll count half of those proceeds to offset that requirement.
Excellent. And have you had any or a fair amount of projects lately that have gone over 12 months? I'm assuming most of your loans are written for a 12-month term, right?
So we've been writing the majority of our ground up at a minimum of like 15 months. Or typically our terms are between 12 and 18, but we've just been kind of spanning along the 15-month mark. I don't think we've had too many issues with projects going over that time frame. It's usually like listed for sale at that 15-month mark and waiting for a buyer, if not about to sell. And in that situation, we're easy to work with, so we'll grant extensions, give you an upfront option and a deferred option. So we're always like to work with our clients there.
Yeah, and I really think it's when you talk about knowing your markets, it kind of helps in terms of, for example, with Charleston, there's a lot of historic overlay. So you actually have what we call the BAR, the Board of Architectural Review. So if you're doing certain flips in certain areas, you have to go through a pretty stringent review process, which can take sometimes up to 6 months or longer. So we're underwriting, in terms of knowing where those properties are. So if we see something in downtown Charleston, we know that they're trying to do something that's going to be material, and they're going to have to go to the BAR. Then we're going to take into account, and then we're going to make sure they have a longer term on their loan to get them to the finish line there.
Great. And we talked a little bit about exit strategies. People exiting into a rental loan versus a flip, versus a sale. But let's break it down by your rehab loans and then by ground up construction. For the rehab loans, are you seeing most of them exit into a flip? And if so, do you know the percentage that are flip versus rent?
That's a great question. I would say it's probably 70-30 sell versus keep. I think that's pretty in line, Alex. What do you think?
I would think so. Yeah. I mean, we're not seeing, which back in the day, so 2022, I would say 2021, we were seeing more of like the complete opposite. So I would say 70, banking it as your DSCR, and 30 on the sale side. I think it's still completely flipped. And I think that's also just where the properties are located. Like we had talked about some of them don't DSCR, especially the higher price properties. There's just no way to, to have your $5 million flip DSCR. So it's, I think that'll change over time as rates still keep coming down, hopefully. But it's just, yeah, there's really no telling, no crystal ball there.
And do you think that ratio is about the same for rehab versus construction?
I'd say the construction's probably a little bit from what we deal with. I would say it's probably more like 80-20 because most of the guys were just doing build to sell, especially in that luxury price point. I mean, getting a DSCR loan to work at 4 mil and on a $4 million new build, it's going to be a tough one. Not to say it can't be done, but it's just the numbers are a little bit harder to crunch.
All right. And then anything else about your guidelines that may be worth noting, or anything I might have missed?
I think the GC experience is kind of one of our bigger selling points currently. And it's really just been a big opportunity to give people access to the loans that might not necessarily have been able to access them in the past. But yeah, I mean, ground up's really our strong suit. The fix and flip is also our bread and butter as well. So we really just pride ourselves in our customer service, and if you call the office, you'll get a hold of somebody instantly. So you won't get bounced around and waiting for answers for days at a time. So yeah, count on us to be responsive. That's for sure.
Love it. Want to move into talking about the company, capital, and then some of the specific markets that you lend in. But before we do that, let's just take a quick break, and we'll be back in a minute. Support for the show comes from Forecasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forecasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forecasa as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forecasa's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market, and we've also added the top real estate investors in each state and for some of the metro areas. Visit forecasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with Kent and Alex from Coastal Equity Group. Gentlemen, let's talk a little bit about your company. Alex, I know you started off the interview talking a little bit about the history, but if you could give us a little deeper dive of your journey in private lending. Kent mentioned that you were rehabbing and flipping houses in Florida and on the west side of Florida, and then you mentioned that you started lending in 2018. Tell us a little bit about that journey from then until today.
Absolutely. So I actually did my first flip in my early 20s. I got it actually from a foreclosure auction, did most of the work myself, and put a tenant in there and sold it to what would be the new landlord who wanted a property for his rental portfolio. And I was honestly hooked after that. Once I realized, the intricacies of real estate, I couldn't find any other way or any other thing I would have wanted to do. And over time, I really started to scale, do more flips, multiple at a time, and actually was a borrower on the private lending side or the private money side. And back in the day, we were borrowing at 13 and 3 with 12-month prepayments, snuck into the loan docs because we didn't know better. So once we sold in 2 months, we owed another 10 months of interest. It was great. That was the back of you go into someone's basement to borrow the money needed for the flip, figuratively, but obviously the industry's changed over a long time. I went to my first conference. I want to say it was 2016. It was Leonard Rosen's conference. It was called Pitbull back then. And we were there, and there was, I want to say, no more than 100 people at one of the first conferences there. And now if you go to NPLA, there's 1,000 to 1,500 people. So it was a whole different industry back then. Like I had said, you really didn't have that institutionalized capital. You didn't have the competitive nature that you do now, where there's just, pop-up shops overnight. But went to the conference, started my PE fund with Leonard and John Hornick at that conference, and that was kind of my intro to lending. I had been on the borrower side. I knew what the experience was like. I knew the number one key was customer service and having a company that understood exactly what the borrower was going to go through, and what that underwrite looks like, where the pain points were. So I think really being on that borrower side to previous to starting the company really helped in terms of implementing implementing that mindset really of going through that into the company, and taking that into account when creating the loan products, when talking to the borrower, with understanding how to make the process as seamless as possible. And then over time we scaled that, and then when we were able to sell our paper on the secondary market and recycle our capital, it was kind of nonstop from there. I had a lot of good borrowers from day one that I knew from being in that flip market, and we've tried to show our our strength by, in the beginning especially, a lot of our lead generation was from repeat borrowers and referrals, and still is. Our retention rate is extremely high. It's definitely over 90%, if not over 95%. And we pride ourselves on being the one-stop shop, and making, like Kent said, when you can call the office, you can get a hold of someone immediately. If you need to get a hold of an underwriter, you probably have their cell phone number. So it's understanding that process and understanding how fast we have to move to get deals done, how fast a deal can be lost if the lending company is not on the same page as the borrower, and just kind of how everything works. And it's been very interesting through the last almost 10 years now of seeing shops open, shops close, aggregators open, close, different pain points in the market, COVID, in terms of a lot of funding that was paused. And it's been a huge learning experience, but so rewarding, especially when we see our clients who have grown from one property to making this their full-time life career. Everybody is I think that's the biggest blessing too, and really seeing kind of that impact, and not that it impacts that one borrower, one client, but it impacts everybody that works for them, and it's a huge ripple effect. So it's really taking that into account, and it's just been a great thing. And over time, we've been able to grow a great team, a great management team, and a great team in general for Coastal. Kent has come on now for almost was it almost 5 years now, Kent?
Yeah, 5 years. Yeah.
And then we have two other individuals on our management team that have been 4 and 6 years respectively too. So it's been a great thing, and we've grown this into a very interesting endeavor. So it's been great.
Love it. And, congrats on, just the growth and the amount of loans you've been able to fund. I mean, 200 million in 2025 is extraordinary. Tell us a little bit about the rest of the operation. I mean, do you have, you said you're adding salespeople in different areas. What are the counts now? Or do you have multiple offices? And just give us an idea of the size of the operation.
Absolutely. So right now there are 10 people on right now in terms of our team. We just hired someone on the North Carolina market, based in Charlotte, to start really doing a lot of business development in North Carolina. We saw a lot of potential there, and we were going to a lot of events up there, but just really weren't able to spend as much time to make an impact. So we did that. Was our first remote hire there. I think our next market that we're going to get into is going to be Southeast Florida. We see a lot of potential in Dade County, Broward County, Palm County, all that Southeast. It's just absolutely insane what's going on over there right now. It's a little scary and intimidating, honestly. But that's going to be probably our next move as well. And in terms of Charleston, we have all of our servicing team here. our main sales team here, taking all of our inbound leads and our outbound South Carolina efforts. We have our marketing team here and all of our underwriting and processing in-house too. So we're able to have really good communication back and forth with each other, on a continual basis throughout the day, with everybody being in one place, which is great.
Love it. And tell us a little bit about your capital structure. You said you're servicing your own loans, but do you still have a fund, the one that you started back in 2018?
We do, yeah. So we do have our PE fund, a 506c. We fund everything in-house, and then we do sell off on the secondary market to one main fund that we work with. And they've been a great partner in the last 4 or 5 years that we've worked with them. And then in the process, even if we do sell a loan off in the secondary market, we do all of the servicing in terms of draws, payoffs, any communication directly with that borrower, so they don't lose that contact. It's not sit and forget it. We're definitely there till the end of the project and beyond.
Love it. And let's shift from talking about the company. Let's get into some of the local markets that you're lending in, and just educate us a little bit about some of these states and the specific markets within them. And let's start with your home state of South Carolina. That's where it seems like the majority of your loans are, and there's so many different markets within South Carolina. Give us a little bit of the layout of the land and some of the major markets that you've lent in over the past year or past several years, I should say.
I'll take this one, Alex. South Carolina is my strong suit. So I've bounced all around South Carolina. I grew up in Columbia, the capital city, which obviously has the University of South Carolina. There's probably 30,000 students to go to that school. So that market is definitely strong. We've seen there's a lot of growth in Columbia. Also just in South Carolina as well, due to the domestic migration and the job growth here. A lot of industries are moving into South Carolina, especially up near the upstate. So Greenville has been a great market as well. I actually went to school in Spartanburg, which is in that same MSA. So I was able to actually kind of witness some of the growth even there during my time in college. And even going back there now, it's just night and day compared to what it used to be. Greenville's got the BMW plant up there where all of the X series vehicles in the United States are made. And those actually get shipped down here to Charleston, which is wild to see. But a lot of growth up there. I know Walmart is building another factory in South Carolina, and I'm sure if you Googled a list of all the new companies that have moved into the South Carolina area over the last year, I mean, data centers are being built. It's just a lot of movement as far as like industry. So upstate's been great near the Greenville area. Columbia has been great as well. But Charleston, I mean, obviously it's kind of an anomaly, and the Charleston area kind of is from Charleston down to Savannah, Georgia. So, cause there's a lot of submarkets like Hilton Head, you got Kiowa Island, kind of around Charleston. But I mean, it's been crazy to see. I mean, the market is just super strong here. I mean, there's so many people that are flipping houses, so many builders that are wanting to do their own spec builds, and even just the construction for people like new builds, custom homes people are moving down here. I mean, it's been lots of growth for sure. And Charleston in particular, we just got a new mayor who actually he used to be a real estate developer, and it's funny to hear our borrowers like, man, the permits now are just like instantaneous, and it's kind of sped up some of the growth here, and he's encouraging that as well as like development in the area. So I think that's definitely going to lead to a lot more opportunity for us as well. Then North Carolina is great too. We've been really focusing on the Wilmington and like the coastal North Carolina. So some of those areas up there, they're great. I mean, super hot markets. There's a lot of old inventory that's up there that's being torn down and rebuilt. So we see that as an opportunity as well. So that would be the Wilmington, Raleigh, Durham area, and then Charlotte obviously is growing a lot as well still, and remains a strong area up there. But yeah, I mean, we're seeing a lot of growth in North Carolina as well as far as industry. And I think that's a big contributing factor. Alex and I went to there was a Fed analyst at College of Charleston came in to do a seminar. We popped over there, and I forget which month this was, but she had told us that South Carolina was whichever month it was last year, I want to say it was probably like maybe around August. She said that South Carolina had the strongest GDP growth in the country and the strongest job growth in the country. So I thought that really stood out and was kind of shocked to hear that. But yeah, just good things for the Southeast in general, I would say.
Within South Carolina, are there particular parts of the state that are more, building new homes where it's more of an expansion that's not tearing down older properties?
Yeah, absolutely. I mean, the path of growth, I feel like, is from going out basically up the interstate outside of Charleston towards Columbia. So if you just follow I-26, I mean, you'll hear about the path of growth, and it's just continuously expanding. I'm not sure if you've been to Charleston before, but when you're driving in or driving out, like it seems like it takes you hours to leave Charleston, and that it gets longer every time I get on the interstate, just because they're building more new communities, like out probably 30 minutes from what I would consider like Charleston proper. But I mean, there's so many new developments going up, new tract homes. But yeah, definitely not just tear downs, just a lot of growth just in general.
Nice. And so South Carolina has a lot of these coastal areas besides Charleston. Are those, like, let's say Hilton Head or Myrtle Beach, are those all vacation resort areas?
Myrtle Beach is a huge retirement area, honestly, and we've been trying to get more into Myrtle Beach as well. Just a ton of golf, and same thing with Hilton Head. I mean, a lot of these are more like retiree, um, just go settle down places, which is, I mean, I think there's a lot of appeal to that, especially from the people that are moving here. Because I mean, if you go to Hilton Head and you buy a house there, I mean, your house is probably going to come with a membership to the golf course that it's on, and then you also have 10 other golf courses within 30 minutes of driving around you. And I mean, I think that's a lot of the people, or that's what they're moving for, just to get away and just to kind of relax and retire. What do you think, Alex?
No, I completely agree. Yeah, I mean, we're seeing, in terms of, it's not just infill by any means. We're seeing brand new neighborhoods, communities pop up everywhere. So, like Ken said, up I-26, you go down towards Savannah as well. Buford is just blown up. So, I mean, there's so many different communities that are just going through exponential expansion like I've never seen. And I think it's just, quality of life. We saw such a change during COVID, with the biggest domestic migration coming towards the Southeast. And then we're also seeing a lot of people who went to Florida halfback, back to the Carolinas that left the Northeast and like Florida, that came back and they kind of found a happy middle in the Carolinas. So we're seeing, a lot of expansion from that too. And then with the job growth and a lot of companies moving here, it's been exponential.
Great. And, I'm looking at a map on Elementix where it has a map and has all the docs of all the properties that you funded in the past year, and I see this a huge cluster around Charleston, but I do see a lot of activity going south to Savannah, and then obviously Myrtle Beach. It seems like all the populated parts of South Carolina you've done loans in. Uh, so let's go down to Georgia next, since you mentioned Savannah. What are some of the cool things about that market that you like, and that have taken you there for all the funding activity you've done?
Yeah. So Savannah's is an interesting area. It's a lot smaller than Charleston, but there's still a ton of opportunity. There's a lot of job growth as well. We were fortunate enough in the very beginning to work with some flippers who do a lot of volume down there and have a lot of experience. So that's been great. We've learned the market over time. It's definitely a market in where you have to really, really understand, certain neighborhoods and certain streets, because valuations do change a lot, even one street over. So you have to understand that market to smartly invest into that area and smartly lend in that area as well. But we've seen a ton of growth there. So, it's just a lot of change. They have their big university, SCAD University down there too. Big growth. It's just been great to see. And then, anywhere between now Savannah and Charleston, there's just tons of opportunities. One of the funny things was when Ken had just come on board, there were areas in South Carolina and Georgia near Savannah that we would actually consider rural, and where we were a little hesitant to lend in back in the day. And now those rural areas are no longer. So they're it's changed so much.
Love it. And then moving on to the rest of Georgia, it seems like you haven't done a lot of lending in Atlanta, but you've done quite a few loans in Augusta and Athens. Or are you just leaning towards those smaller markets, or is it Atlanta just so competitive at this time?
It's Atlanta's really competitive. And to be honest with you, we haven't really done a ton of like Atlanta deals. I mean, we've done some like Buckhead, like some like smaller markets like outside of Atlanta. But it's just really competitive in Atlanta. But as far as the flips, I think they probably got some pretty aggressive lenders down there to kind of somewhat of a stronghold. But we have a couple repeat custom builders there that are doing the outskirts. But yeah, in a few sub markets throughout. I know we've done like Marietta, Georgia, for one or two, and then definitely Augusta.
All right. And within Georgia, let's take those four markets. Okay, well, maybe forget about Atlanta because that's obviously, built mostly, and I mean it's still growing, um but do you see a lot of growth with new building in Athens, Augusta? Do you think that's more than what you see in Savannah, or is it just growing everywhere?
I know in the very beginning, we definitely saw, or I at least saw when DSCR used to pencil really well, we saw a lot of people going into Augusta and Athens in terms of just cash flow, in terms of that motivation. And then we've actually had a lot of clients in Charleston that we've known that have also expanded into those areas. So then, we kind of followed suit and being able to lend to them in other markets that they wanted to pursue as well, and they saw a lot of opportunities there. But we're not technically really, active boots on the ground in those areas. But we do feel comfortable enough to lend, especially if it's a repeat client of ours too.
You're in Athens. I mean, you've got the University of Georgia there, and that's a hot rental market, hot flip market. I mean, that just kind of like Columbia is too. I feel like college towns are kind of insulated in themselves because you've got that backstop of parents will pay out the rent if the kids aren't doing it, or they're usually paying their kids rent. So, and the plethora of potential renters that you have is just that has become limited. So that makes it really appealing and kind of gives us a little more ease there.
Nice. Great. All right, let's move on up north to Tennessee. I see you've done some lending in obviously the Nashville market, but you've also done some loans in Knoxville and Chattanooga. Tell us a little bit about how you look at Tennessee and how you look to expand there.
Could have got Gracie on here, Alex.
I know. Gracie's originally from Nashville, so that would have been good. I know one of the focuses, and one thing that I keep hearing industry wide is that people are a little hesitant of, especially downtown Nashville. It seems like there's a lot of inventory, especially on that condo market side. Things were a little built up a little too fast. But one market that we are still definitely hot with are the suburbs of Nashville. So if you go into Brentwood, areas like that, some of the nicer spec builds, that's definitely something that we like to entertain, and we feel comfortable, and we feel like it's a very stable market for now.
Got some consistent repeats up there that we've been funding, and they're all just really operating in the sub markets. We haven't really gotten a lot of inquiries about like downtown Nashville deals, and like Alex said, I mean those would definitely be a little bit looked at under a magnifying glass just due to the concerns with the valuations that we've been seeing in that area.
Nice. And the other parts of Tennessee, I see you haven't done much in Memphis, and that's a market that a lot of lenders avoid, but it seems like you have done some lending in the other two, Chattanooga and Knoxville. Is there a lot of growth there, or those more rehab type markets?
Knoxville is definitely growing. They're actually in the midst of building a new football stadium for their team for the for University of Tennessee, and I actually went up to Knoxville for the first time like last year, and I thought the city was amazing. And I mean, it seems like they've got a lot going on there. There's so much construction as far as like new apartment complexes being built. Definitely seem like they're making a push to put Knoxville on the map a little bit. Yeah.
Great. All right. Before I let you go, the last market I wanted to talk about is the big one, Florida. So it looks like you've done a ton of loans in all along the west coast of Florida, where, mostly in the Tampa Bay area, going down to, Cape Coral.
We were very strong in terms of west side of Florida a few years ago. We've definitely taken a little bit of a pause in certain markets. We're just seeing a lot of inventory, especially in that Cape Coral, Lehigh Acres area. We saw a lot of built, especially there was a lot of the resi for rent at that time, and a lot of people were just gung ho building as many as they could of that 300,000 to 400,000. 1,700 square foot cookie cutter house. So we've seen a lot of that inventory on the market. I pulled up a map recently, and just to look and see what's listed is a little scary. I think we're starting to see it. Hopefully, inventory turnover a little bit better than it had in the past. But a big focus of ours now is East Coast Florida. So just the things that we're seeing in Miami, Fort Lauderdale, Delray, Palm Beach, the amount of people that are moving down there, a lot of money coming in from South America too. The price points are just, it's a little overwhelming. Ken and I were just down there visiting clients a few weeks ago. And I remember we went to one neighborhood in Miami, and I would say every other house was getting torn down and built up. It was something I haven't seen, and they were all going to be listed for between $7 and $12 million. So it's just it's a different world down there, different world.
Nice. What about Orlando and Jacksonville? Are those markets that you're excited about expanding into?
Ken, you were just in Orlando.
Yeah, I was actually just down there last week. We really don't have a lot of repeat clients in Orlando. I've got one that I've been working with for the past couple of years. He's doing the build to rent model. It's working out pretty successfully for him, right around that $1 million price point range. But I don't know. I know some parts of Jacksonville kind of softened up, and we saw a little bit of issues with them last year, but I'm not thinking that those are nearly as bad as on the southwest side, where we're like Cape Coral, Lehigh Acres. Those are bad words. So we those have kind of been some of the bigger pain points for us. But I mean, Orlando, Jacksonville, I think they're still good markets for sure. Orlando is always going to be strong, obviously, with all the tourism, especially as a rental market. Jacksonville, same thing. But yeah, we've seen them. They've definitely picked back up as opposed to what we were seeing last year.
All right. So for 2026, you're pushing for South Florida. Obviously a very competitive market, but you've been very successful at ground up construction lending and the rest of the Southeast. So I'm sure you'll fare just fine over there and pick up some good business there.
We're optimistic. Right. I'm hoping for it.
Yeah.
All right.
That's the plan.
Sounds good. All right, gentlemen, that's all I had on my list. Anything else you wanted to add? Anything I might have missed?
No, just Rocky, as always, appreciate you having us on, and thank you for hosting. This has been great.
Absolutely.
Totally appreciate it.
And that's a wrap for this episode of Private Lending Insights. Coastal Equity Group has been listed on privatelenderlink.com since 2022, and they pay a monthly subscription to be on there. I put a link to their profile in the description. You can contact them directly by phone, by a short email form, or you can submit a loan request. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. Thank you for tuning in and listening all the way to the end.